Hi, my name is Jordan Wilson. In our last episode, we talked about buy and hold, but review. And that's where we're going to move now, is into how to review your investments and your overall portfolio. Now, the first thing you need to do is to create something to compare your portfolio and its performance to, and that would be a benchmark. So we're going to look a bit at some different benchmarks in the next few episodes, and you can plug and play them as they're applicable to your own portfolio and your own individual investments. And the key thing to remember with all this is apples to apples. And that's kind of a recurring theme with risk relationship, is you want to make sure that you're comparing apples to apples, not apples to oranges. And when we looked at risk or returns, again, when we're assessing potential investments, we need to keep things equal. We can't be comparing returns of something with a vastly different risk profile, because then that throws everything out of whack. So today, a little bit on the basics of portfolio benchmarks. First of all, what is a benchmark? I think that's literally any figure that you use to compare or to measure the performance of your actual portfolio. And I think the keys are that you're looking for a benchmark that reflects your personal circumstances. And that's going to be your investor profile, driving your target asset allocation and your risk tolerance, all that good stuff. It should reflect the portfolio. Again, apples to apples, not apples to oranges. It's useful to choose benchmarks that are based on readily available information. And there's a lot of information out there today, so that makes it easier. But if you're trying to set up a customized benchmark for a customized portfolio, you may have difficulty getting a perfect fit. So bear that in mind. Now, as far as some common, simple benchmarks, I think the first one is, we'll call it a zero return. And that's going to be any positive nominal return. Anything over zero is good. We don't want to lose money on our portfolio. So I think just intuitively, when you're looking at your portfolio, forget the risk return and the expected returns and all that stuff. You just want to come out ahead. So for many people, they just instinctively select zero return as a benchmark. And obviously that is very simple to track. I would say that the zero return, or just a positive return, is probably best for lower risk individuals who are investing in low risk assets like cash equivalents or shorter term fixed income. But I think it's just, again, an intuitive benchmark. It's not something that you want to use in isolation. Another common benchmark for people is a positive real return. And that would reflect anything over the rate of inflation. So if inflation is running at 2 or 3%, and you are using a benchmark of 0%, you've already lost. You need to, on a purchasing power basis, get that return at least higher than the inflation rate. So that is important to consider. And I think that if we look at a very quick example, simple example, if you have $1,000 to invest and you earn 10%, at the end of the year it's worth $1,100. That's pretty good return against a zero return benchmark of 0. But what if the inflation rate is 15%? So your purchasing power in general is that a basket of goods and services that cost $1,000 on January 1 will now cost $1,150 on December 31st. You've earned 10%. Your portfolio is now worth $1,100. But on a purchasing power basis, you've actually lost money. You've lost $50. So again, a lot of people are probably better served to factor in inflation rates and ensure that on a real return basis, they're experiencing positive returns. Similar to that would be the risk-free rate of return. And that's generally considered short-term US or even Canadian government T-bills. And that is considered the rate of return that you would earn on a investment with no risk. Now, the risk-return relationship is such that if you take on any level of risk, as a rational investor, you will demand a higher return. If fully backed US government short-term treasury bills provide me with a return of 2%, then if I take on longer term government debt, there's a little bit more risk involved. So I'm going to demand a higher return for that. And if I get into corporate debt, on average, that's going to be even more risk than a US government or a Canadian government backed debt. So I will also demand slightly higher return for that. Or if we look back at our fixed income discussion, you can also see that there's perks that are built into bond issues or fixed income issues that allow for lower interest rates but give you, as an investor, an upside elsewhere. Maybe convertible, maybe callable, maybe redeemable. These sort of benefits that are built in to offset and attract investors. So if you're invested in a risky portfolio, risky in any sense, just sort of a mix of high quality equities and some fixed income, that is going to be a riskier portfolio than US Treasury bills. So you need to ensure that you're outperforming the rate of return on a risk-free asset. And so that tends to be factored in for most people as well. 0 isn't the right number. Maybe inflation is better, but the risk-free rate is better still. And again, like with zero returns or the real return or the risk-free rates, that's probably better suited to people that are in lower risk investments. But it's also a good ballpark just for any investment. If I've invested in 80% small cap growth funds from emerging markets, then I'd better have a higher return than no risk treasury bills. So again, you want to take that risk and make it on an apples to apples basis. Two vastly different investments, but you can judge if the risk-free rate's 2% and you're small cap emerging market growth stocks earned you 3%, maybe you're not happy with all the risk you assume just to earn 1 extra percent. And then the last one is the arbitrary, and that can be nominal or real. And that's just picking a number out of the air. Maybe it means something, maybe it doesn't. A lot of people say, I want to earn 10% on my investments. That's a number kind of plucked out of the air. You could also say, I'm investing, I want my wealth to double every 10 years. And so under the rule of 72, I need a 7% annual return. That's a little bit more structured in thought, but still kind of nebulous. A lot of financial advisors and clients say, I'm saving for retirement and I need to amass $2 million at age 65. And if we go back and we look at your initial capital, your planned periodic funding, then we can calculate what sort of rate of return you need to earn to reach that $2 million goal. And again, as we looked at before with the relationship between time, funding, and risk, the closer you are to 65, the more you're going to have to fund, or you're going to have to seek higher returns and take on extra risk. But that's another more common calculation. And the real return is, okay, inflation's pegged at 2 or 3% this year. I want to make at least inflation plus 3%. That's my goal. So that would be an example of a arbitrary real return benchmark. So that's kind of where we are on some very rudimentary benchmarks, but they're simple. They're easy to understand, and many people like to use them. And I am fine incorporating them in an overall benchmark process, just sort of that sanity check, as it were. But when we look at the next few episodes, we'll start drilling down and trying to get more applicable, relevant benchmarks for your portfolio so that we can actually, again, the apples to apples, maybe a 70% equities, 30% fixed income portfolio compared to the risk-free rate or the zero rate or some arbitrary rate does not make a whole lot of sense when you're trying to determine how you actually did. So we want to start drilling down a bit and trying to find benchmarks that do a better job of giving us feedback on how our performance is doing for that portfolio. So that's where we're going to go over the next few episodes. This is just a quick primer on what benchmarks are and some very simple common ones that most people incorporate in their analysis when they do portfolio reviews, say on an annual basis. Thank you for your time today. Have yourself a great one.